On February 1st, 2018, a Swiss banking giant called Credit Suisse was sitting on a product worth $1.9 billion. 4 days later, at 4:15 p.m. Eastern Time, that same product had lost 96% of its value. 15 minutes, that's all it took. And the people holding this thing weren't retail gamblers. SEC filings show the biggest holders included Citadel Advisors, 2 Sigma, Deutsche Asset Management, and, this is the part that gets interesting later, Credit Suisse itself. By the end of this video, you'll know exactly what this product was, why one sentence buried in its paperwork guaranteed its death, and why Credit Suisse being its own biggest customer might be the most important detail in the entire story. Let's open the file. Here's the product. In 2010, Credit Suisse, through its Nassau branch, issued a note called 14, built and branded by a firm called Velocity Shares, founded by a trader named Nicholas Cherney. Technically, it was an ETN, not an ETF, a debt note backed by Credit Suisse's promise to pay, not a basket of assets. But almost everyone, including financial media, talked about it like a fund. In 2014, the Velocity Shares brand was bought by Janus Capital, the same Janus known for mutual funds, who took over marketing it to retail brokerages nationwide. So you had a Swiss investment bank on the hook for the payout, and an American asset manager selling it to Main Street traders. The pitch was simple. There's an index called the VIX that spikes when markets panic and drifts low when things are calm. XIV let you bet every single day that calm would continue. And for years, that bet printed money. Between the Brexit vote in June 2016 and February 2018, Fortithies returned investors roughly 487%. Some early holders, going back to 2011, had turned $10,000 into close to $290,000. This wasn't a fringe product either. Reddit had entire communities built around shorting volatility. It had become one of the most crowded trades in the market. But buried in Credit Suisse's own filing was a single clause. If XIV's value ever dropped 80% in one day, it would trigger an acceleration event, an automatic, irreversible shutdown, not a pause. A permanent liquidation, with holders cashed out at whatever the ETN was worth days later. Credit Suisse's own models, back-tested against 1987, against 9/11, said this had never happened and looked nearly impossible. Then came February 5th, 2018. The S&P 500 had an ugly but ordinary day, down around 4%. But the VX doesn't move like a stock. It jumped from roughly 17 to over 37, more than doubling, the largest single-day spike ever recorded for that index. Here's the mechanical trap. To keep delivering the inverse return it promised, Credit Suisse's hedging desk had to buy back VIX futures the instant volatility rose, automatically, regardless of price, because that's what the note structure legally required. So as the VIX spiked, Credit Suisse's own hedging was forced to buy the very thing that was spiking, pushing it up further, forcing more buying. Some reporting at the time even suggested Credit Suisse had become the largest single holder of its own product, meaning the firm hedging the panic and the firm causing more of it were, in effect, the same desk. By 4:15 p.m., Credit Suisse's indicative value had fallen from over $131 a share to $4.22. The next morning, Credit Suisse confirmed the termination clause had been triggered. $1.9 billion in investor capital was gone, and the product ceased to exist within days. There's one more twist worth knowing. 3 days later, a rival product, ProShares SVXY, which used a similar short volatility strategy but wasn't structured with a hard termination clause, took in $300 million in new money in a single day. Investors didn't abandon the strategy. They just moved to the version that didn't have a built-in death switch. So, what's the real lesson? It's not volatility products are dangerous. That's the surface-level takeaway. The real lesson is that the issuer's incentives and the product's fine print matter as much as the strategy itself. Credit Suisse designed the hedge, sold the product, and, by some accounts, ended up as its largest holder when the trigger hit. Janus marketed it to retail investors who, in most cases, never read the clause that could erase their entire position in an afternoon. Before you buy anything built on leverage, inverse exposure, or automatic rebalancing, ask 3 questions. Who's actually on the hook if this fails? What are they contractually required to do on the worst possible day? And who benefits if that day arrives? There are more of these stories. Funds that looked bulletproof, right up until the fine print did exactly what it was written to do. If you want the next autopsy when it drops, you know where the subscribe button is.